Hi guys, a very good morning. You've tuned in to this live broadcast here on Moneycontrol. You're watching Opening Bell with me, Stacy Pereira, and I'm here to take you through all the news and cues that would go on to impact your trading day. And we've been seeing quite a bit of swings, one would say, in the equity markets. Yesterday we saw that good recovery or bounce back, but if you have to look at the handover that we're getting from Wall Street and the other Asian indices, that seems quite weak. Even the Gifty Nifty indicating that tepid start, we would say, for the Indian equities. So let's get into all those details on what's really changing for the Indian equity markets and what we need to be looking forward to in terms of stock specific action. We'll get to all of that with our guest as well. But first, let me take you through all the other headlines that are making news. Well, Wall Street snaps its three-day gaining streak as the hotter than expected February producer price index report goes on to spook investors on Wall Street. Asian markets too trade with some bit of losses, while the Gifty Nifty is indicating a lower start for the Indian markets. And OMCs go on to cut petrol and diesel prices by 2 rupees a litre, even as crude prices continue to rise. Prices of CNG and LPG are also cut. Does the industry have more headroom for price reduction? That's what we're going to be asking on the show. But crude prices, those ones also continue to rally, with the Brent crude now trading at $85 a barrel. And mutual funds have started releasing results of SEBI's stress test, with the industry-wide disclosure likely to come in by the end of the day. Remember, the results will indicate the days needed to liquidate about 25% as well as 50% of the portfolios in a predefined stress situation. And among stocks that you need to be watching out for today, well, do look out for 197 Communications, that's the parent of Paytm, after it has got NCPI's nod for the third-party agreement of a UPI aggregator ahead of RBI's March 15 deadline, which comes in today. Also look out for OMCs after those fuel price cuts, and Ashok Leyland after Creador will be investing about 50 million or 19.6% stake in Hinduja Tech. And on the political front, we're seeing a lot of action around the electoral bonds, and the Election Commission now has gone on to release SBI's submission on electoral bonds, with Future Gaming as hotel and services PR emerging as the top donor with 1,208 crore rupees donated. Other donors include Mega Engineering, Vedanta, Bharti Airtel, DLF, JSPL, among others. Lots to be looking out for in trade. Of course, it's the end of the week, and if you have to go by weekly data, well, the Nifty is showing some bit of despite, but we'll have to see how today's trade actually, whether it goes on to put that bit of pressure on the benchmarks. If you look at the mid-cap and small-cap, that one at least managed to show some bit of strength yesterday. But after the stress test results coming in, we'll have to wait and see whether those two go on to buckle under pressure. But let me also take you through some of the cues that you need to be looking out for on the F&O segment. And if you have to look at option cues, well, the Nifty put-call ratio, that one really has come and jumped up, we would say, back to that 1.12 levels yesterday as compared to the 0.65 it was at the previous session. And remember, above 1 PCR really indicates that there are the trading volumes are more for the put options. For put options is more than what it is for the call option, and this generally suggests that bearish market sentiment ahead. Now, what should we be taking out from here? If you look at the F&O ban list, that one we are seeing NSE that has gone on to add BHEL to the F&O ban for March 15. It has also retained Aditya Birla Fashion and Retail, Manappuram Finance, Nalco, Piramal Enterprise, RBL Bank, SAIL, Tata Chemicals and Z Enterprise. Now, these ones have been in this list for some time now. All through last week, we could say barely 1-2 exclusions that have happened since then. And another one that is excluded for March 15 trade will be that of Hindustan Copper. That one has been removed from the ban list by NSE. Let's also take you through the fund flows that we've seen in yesterday's trade. The provisional data that has come out goes on to show that foreign institutional investors were a big seller in yesterday's trade. Of course, even though we saw that bit of recovery that perhaps is coming in from the retail and Indian domestic investors. But if you look at FIIs, they went on to sell shares worth about 1,356.29 crore rupees. Domestic institutional investors tried to hold out but went on to purchase just about 139.47 crore rupees worth of stock on March 14. So that is the setup pretty much that we have in place. We also had data coming in from global markets which pretty much reacted to that US Feb PPI number, which came in at 0.6%, gone on to spook a lot of those indices on Wall Street, as well as you had crude prices also which continued to surge, reaching that 85 barrel a dollar. So all of these pretty much playing out also on what we're going to see if the markets do here. Now, there is also the SEBI board meet, which is going to put a lot of light on how these markets are going to go ahead and what is going to be the stress points, and we'll be getting you all those details on that as well. But let's discuss specific stock action and what your strategy needs to be for today. And joining me to do that is Brijesh L. He's the head technical and derivatives at IDBI Capital. Good morning, Brijesh. Thanks so much for speaking with us here at Moneycontrol. Let me just get a sense from you. What are you looking at the markets do? We saw a big sharp sell-off day before yesterday. Then markets wanted to show that, the bulls can still have some bit of command. But today, after this handover that we're getting, which seems bit of quite weak, one would say, where really are we in and how is one supposed to be trading in this market?
Yeah, morning, Stacy. So I think what we saw on Wednesday, the correction, the big correction in the market, almost 350 odd points correction. So that was something which is not good. So markets are sentimentally, it looks there can be a further profit booking in the market. Having said that, the Wednesday and yesterday, the market has held to 21,900 level and it has seen some bounce. So technically, we are seeing this bounce as a breather for the Wednesday correction. So my overall directional sense is that we might break this 21,900, maybe not today, but then there's a fair chances that we might break in the next week. So bias is cautious. I don't think Nifty will very easily cross 22,300 mark on an immediate basis, and near the all-time high which we saw at 22,500 is likely to be stay for at least for the March series. Maybe once the March expiry is over, then we may figure it out. But then right now, at least for the next 15 days, I think that 22,500 is going to act as a major resistance, and that is to be the likely top for the March. Going further, we are extremely cautious because there has been a distribution pattern in the index, and this clearly says that there can be a further correction. Irrespective of whatever the news come, I believe once we break 21,800 mark, then we are going to slip into a good amount of correction, and Nifty index may come close to 21,000, 21,100. So we are extremely cautious. We are going to exit our long positions whenever we see that 21,800 is broken on a closing basis.
Right.
So we have a cautious view, and so we will be sticking to that.
Right, Brijesh, that is for the Nifty, but what about the Bank Nifty and how should one be trading there? Because those two have been seeing some bit of, divergent in terms of its trends in what the PSUs are doing. If you have to look at yesterday's top loser was, Axis Bank among the banking pack. So what really is happening even on the index as a whole, the Bank Nifty index, as well as individual stocks? How is one to be looking at banking stocks?
So basically, banking was one of the underperformer. When the Nifty made the new all-time high, Bank Nifty was struggling to cross 48,000, and eventually Bank Nifty made a high close to 48,000, but that was the gap area that it filled, and it is again correcting down. So if you look from the intraday or maybe from a day or two perspective, Bank Nifty is near the support zone of 46,500, 46,000 level. But the having said this, the outlook doesn't look that strong because the stocks like IndusInd Bank, Axis Bank are at the verge of giving us some small further profit booking. So any weakness comes in the Bank Nifty, I think IndusInd Bank, Axis Bank will see some more corrections. Only on a stronger note, only ICICI Bank and HDFC Bank. This is only two private banks which is holding up, and I think that's the only one reason why Bank Nifty is still above 46,000 level. Directionally, the way I spoke for Nifty 21,800, my level for the Bank Nifty is 46,000. So by any chance, things doesn't go right and 46,000 level is taken down on a closing basis, then I fear the Bank Nifty will further correct on the lower side. There has been a range of 2,000 odd points where the Bank Nifty has been trading for 46,000 and 48,000. So if there is a breakdown, then we should be talking of 2,000 odd points correction in the Bank Nifty. So that would be the directional view. All the long positions should be exited at 46,000 levels are taken down on the closing basis.
Keeping a good 700 points if you have to look at today's trade also from where the Bank Nifty has closed. Brijesh, do stay on with us. Quickly, I'm going to address a couple of stocks and one of them being Paytm. Now, this after it has managed to get the NPCI's nod. The parent company, at least 197 Communications, has got the nod to go on to be a third-party application provider, or TPAP as they call it, and under multiple bank model. This is similar to what Google Pay or a Phone Pay does. So that's what they're going to continue their UPI operations is what this really means. And Paytm will go on to provide those payment services in partnership with a couple of banks. Now, which are these banks? There are about 4 of them that it has partnered with. One is Axis Bank, HDFC Bank, SBI, as well as Yes Bank. And all of these will be that payment system provider. Brijesh, maybe you want to quickly come in on what Paytm should be, what should be the strategy. This is obviously positive news, but it is on expected lines that it would continue with its UPI services. But Paytm as the stock, how would be your position right now?
Yeah, so maybe not from the directional point of view, but for the trader community who want to play the 10-15% kind of a move, there is an opportunity in Paytm. I think it's at the bottom. Risk reward ratio is favorable. Somebody wants to play that 10-15% kind of trade. I think one should take the long trades in Paytm.
Right. So you could take, at least for traders, maybe this could be an opportunity, and that's what they've been saying, because we had perhaps reached the bottom maybe at this point. But let's look at markets. That's on your screen. The opening trades that you're seeing, that little bit of pressure, of course, but holding on to that 22,000 at least levels that we are in. Some bit of pressure, about 0.5% lower, because that handover pretty much really suggested that we would be trading under pressure, one would say. Sensex again not managing to hold on to that 73,000 levels that it closed at in yesterday's trade, but about 0.3% lower. Bank Nifty also, they're trading at those 46,600 odd levels. So that again looking at some bit of traction, one could say. But in these initial trade moments, you don't really know the direction as such it would take, because yesterday as well we started off started off lower, but then we managed to get some bit of traction and hold on to those gains at least, and which is why we saw that recovery from those sharp cuts that we saw day before yesterday. But if you took a look at the broader markets now, that's where all the action is today, specifically when a couple of mutual funds will come out with their stress test numbers. That's the indices that you want to keep out on your radar, the Nifty Midcap as well as a small cap indices, the BSE small cap as well, those ones trading a little bit of pressure, one would say. But I think as and when the different mutual funds come out with their numbers, that would give some bit more of clarity of how one should really be trading in them. The small cap indices, they're holding out, one would say. Pharma also looking at some bit of pressure, almost 0.5% down in this early minutes of trade, one would say. The auto pack as well, 0.3% lower. So you are seeing some bit of you can say some of those cyclical metals are holding out there at this point, but just about flat, one would say. So we'll give it some more time. In the meantime, let's see who's really contributing to these gains and losses that we are seeing for the sectoral indices specifically as well. Let's look at the gainers on your screen there. Power Grid, Adani Enterprise, Tata Consumers. Interestingly, Tata Consumers was among the laggards yesterday. Adani Enterprise, though, has been continuously in that gainers list. You also have IndusInd Bank, SBI and Nestle there on your screens, who are making it to the top gainers. Bharti Airtel, Adani Ports as well as NTPC on your gainers list for the day. But let's see the flip side and the laggards and what's really changing there. We have BPCL, which is interesting because we're going to be talking about OMCs and why BPCL is seeing this bit of some negative measures coming in there, even after the government has gone on to slash prices for fuel. We are going to talk about that in details. Grasim, another one making it there. Infosys, Axis Bank again on that losers list. HCL Tech, DV's Lab, all of these in your laggard. In M&M, You also have ICICI Bank and Ultratech Cement. So mixed range, we would say there, of what kind of stocks are making it on that list. But we did see some stocks from the banking pack in the positive, as well as some like Axis Bank, they're continuing to be a laggard in trade. But let me get back Brijesh and ask him, how is he looking at the market opening? What would be your first takes? Are these the levels that we can continue in, and what should be the strategy now that we've seen this kind of, I wouldn't say gap down open, but that pressure still there, at least on the benchmarks?
Yeah, so I think with the opening trade, there are some buying which we can see in the PSU banks and the realty. So this can be the two sectors where we need to keep a watch on. And if you see the entire for the entire week, IT was one pack which was seeing some amount of buying. For example, stocks like HCL Tech and TCS, these are the two stocks which was seeing a decent buying throughout the week. So for example, today if the day ends on a good note, then IT can be the one from the weekly sectoral point of view can contribute to the gains. And from the intraday perspective, I think there is some momentum in the PSU bank and realty space. So I think we need to keep a watch on those sectors.
Right. What about, I'm trying to get a broader perspective right now, but the broader markets as such, mid cap, small cap, how are we to be looking at these indices as well as the components of them? Because that is somewhere where, everyone is raising those alarm bells at this point. You also have the SEBI board meet later today, which, we might get more clarity on how, what they are looking at. They just flagged off the fact that there could be some bit of manipulation that is happening in the SME segment. Is that a reason to worry, and how should one be looking at mid and small cap at this point?
I think we need to be cautious because the way the index has corrected in the last few days, close to 10-15% odd corrections we have already seen. And I think it's overall the mid-cap space is already overheated. It's in overbought zone. I think mild correction is expected, irrespective of whatever the news we see. I think there will be a slight further correction in this space. We need to wait and watch for the next couple of days. And once this cool off, then I think we can again, with the stock specific actions, we can trade a buy. So technically, I would be positive wherever the stocks which are coming close to 50-day moving average from the technical perspective, and when the risk reward ratio is favorable, you take the approach. But I think today being a news event day, I think it would be wise to ignore the day and just wait and watch, and then look out for the fresh trades.
Right. So that can be the strategy. In fact, we'll be discussing that. Quickly, let me also bring in my other guest. Joining me is also Deven Choksey from DRChoksey Securities. Thanks so much for joining us this morning, Deven. Good to have you at a time when, we are seeing such big swings in the market, and one is really looking to understand what should be that direction, or what should be that strategy one should really play out. Now, we're seeing good gains and then suddenly see this bit of correction that, makes us more cautious. Then you have directions that are coming in from the regulator as well, which is spreading that, little bit of worry. So what would you suggest at this point? What should be the strategy one should use, especially when it comes to, what we are seeing in the mid cap and small cap, whether that party is really over and one should now be, playing that rotation because now is the time for it.
Good morning. Well, I don't think that we can easily generalize about the mid cap and small caps. There are companies which are with stretch valuations. There are companies which are adequately and richly valued. And there are companies which are driven by the liquidity tailwinds. So to a greater extent, I think you have the extreme created in the marketplace in a given situation when the liquidity remains extremely high in this kind of market. In my understanding, the fundamentals of the business in respective companies, they are absolutely unquestionable. And that is where I am really more confident about the going ahead as the strategy is concerned. Wherever we see, I think some of the mid-sized, small-sized companies becoming larger over a period of time. And at the same time, I think they play a critical role in remaining connected with their bigger customers. I would think that those companies should be looked at very carefully. I think in this kind of a market times, when the prices have corrected and should it correct further, I think that would be causing a buy opportunity to some of the select names. Having said that, I think those select names, we'll have to study them long before getting into them, just because of the news. So yes, I think the strategy would be cautious, but at the same time, I would refrain from generalizing the overall small and mid cap space. I would rather think that I think where the access is being done, there you remain a little bit more cautious. But where the fundamental remains strong, you can look around for the opportunity to buy in the dips in the market.
Right. So strong fundamentals is what you need to be looking out for, and don't just panic, at least when it comes to mid and small cap with all the news flow that is coming in. But Deven, let me also get your focus on OMC stocks. Now, the government has gone ahead and slashed prices of diesel and petrol by about 2 liters, and this after almost like it's happening after a really long time that they've managed to keep this unchanged. But at the flip side, you're also seeing crude prices, and that one is also increasing, but has managed to give the government some room. Perhaps you could say just before the model code of conduct comes into play, this would have been a strategy that the government wanted to use. But for OMCs, what does this really mean? Because they've been so far, is there really headroom for this price reduction when the OMCs are concerned? Because and how are they really going to be reacting to this?
So there are multiple points I think which one can discuss, and I think at this point of time I would say that this government is playing very smart. I think they are actually they are collecting the money when they must collect, and then they refund that money back to the consumer when I think they can. In the earlier times when the crude oil prices came down sharply, they never brought down the prices of the commodity fuel. And today, I think when the crude oil prices are remaining slightly above, they are not passing on that cost to the end consumers. On the contrary, I think they are bringing down the price for the end consumer. So in a way, I think their balancing act is, I think, quite decent, I would say, in the best interest of the consumer. Now come to the second stage, which is the OMC outlook. And the OMC outlook, I think, to me, it's always difficult to predict, largely because of the fact that I think when the decisions are being made by the government on the pricing front, I think you have very little choice but to follow those decisions. As of now, I don't think that I think for next 3 months or so, majority of the I think issues one can talk about in case of OMCs. Already, I think one has seen in the last quarter significantly large amount of value contribution which came to OMCs because of the GRM coming into their benefit, and I think the OMCs were in a position to collect higher price as we talked about. Now today, I think that may not be the situation. This quarter, I think, may be a rationalization quarter. So to my mind, I think if you want to play the commodity, buy where it is low, and I think sell where it is high. That should be the approach that we play in OMCs and all commodity stocks per se.
That's a nice, interesting strategy that Deven has pointed out. Do stay on. Let me get Brijesh back on and get his sense on, how one should be looking at stock-specific action when it comes to OMCs. Because on your laggard list today, at least BPCL has made its way there among the top laggards in trade. But in stock-specific action for OMCs, how is one supposed to be looking at those?
I think in OMCs, basically there's a trading opportunity. HPCL, the opening is not that great. For the BPCL, I think there can be some positive move. I think BPCL has taken support from the day's low. We can look for some bounce, not too much of a bounce, maybe somewhere to 610 level. That can be the bounce which can be seen in BPCL. So there remains one small trading opportunity. Rest, I think it's a wide. Post the news, I think everything is discounted. So a slight opportunity in BPCL, rest there is no any specific trade setup.
Interesting. Deven, maybe I'll get your view on the whole NBFC space now, because that is another one that has seen some bit of, a lot of action from the regulatory side, one would say, and also from how these stocks are really reacting to all the news that is coming in. Now, you had IIFL Finance, GM Financial, all of them being pulled up. You also have Paytm on one side, which is managing, get back some of those, the big sharp cuts that it saw, with some bit of positive news flow coming in for that counter. Whereas, there is a whole kind of, I think it's more to do with the regulations that are coming in. If you look at yesterday, there was the Indian Bank and the others which have stopped onboarding new customers when it respects to credit cards. Does this space, is this a void for now, you would say, at least the NBFC financial space?
So I have always asked this question. Is the business outlook for NBFC bad? Are those companies not doing well? Is the credit growth rate come down? Has the credit growth rate come down? According to me, I think none of these questions are having a positive answer. I think everything is basically saying that no, I think the business is absolutely fine for NBFC's credit growth rate. I think is absolutely I think in intact, and most importantly, they're in a position to protect their margins. So if everything is in positive, then what is negative? The negative is because of the regulatory actions. If the answer is yes, then I think how long it is going to survive. Probably regulatory actions are meant for correcting the practices. And to me, I think it's a good thing to happen.
Okay.
I would rather consider that any of the strong NBFCs, given the kind of price correction due to regulatory actions in whichever form, I would think that I think it could give a buy opportunity to the investors because it is at this point of time when investors would probably I think look around for price discount, and that is what is available in the marketplace. So I would be extremely strong and convinced about I think the prospects of likes of Bajaj FinServ or Bajaj Finance or for that matter Poonawalla Fincorp. Those companies have probably I think got enough amount of business to talk about, and one can possibly consider those kind of businesses to add into the portfolio. Having said that, I think this could be added with a disclaimer that these companies we have investment interest. These names have been given only for example's sake.
Yep.
Investors will have to look at I think their own advisors to before buying it.
Right. Also, Deven, we are so close to, having the election announcements being made, the dates for the general elections. In that run-up, we've seen a lot of PSU stocks really have that party. But do you think it's now time where valuations have gone out of hand, even when it comes to PSUs? Of course, when compared to private, if you're looking at banks, maybe that still has a better comparison. But when it comes to defense stocks and others, they've actually, kind of got re-rated already. And do you think that PSU party is now something that people need to be re-evaluating?
The headroom for appreciation in the stock price is one aspect, and the second aspect is about the fundamentals of the companies and the business. When it comes to fundamentals of the companies and their business, I think they are absolutely intact. In fact, I think as we see, they are growing and growing very rapidly. So that is an area where we remain extremely convinced and confident about, because government's largest thrust is on creating the Make in India in the defense. And that's where probably I think some of the PSU companies are very well positioned in this kind of an environment. What is a challenge out here is to make money out of the stock market in these companies. Largely because of two reasons. So one, the results are never consistent in most of the PSU companies. They are actually fluctuating on a quarter-over-quarter, year-over-year basis, which is, I think, something which investor would not like to. Investor would like to see the sustainability in the result. The second point is about the price. In my viewpoint, I think the markets have basically, I think, re-rated the stocks, and they have actually closed in the gap between the potential price versus the current price today. So from that perspective, the appreciation prospects are remaining slightly muted at this point of time. Having said that, I would probably look at these companies afresh, some of them at least, if not all, to buy into the portfolio in the corrective prices. So I think what means more to me at this point of time, when the stock market corrects with the price, I think that is the time to go into the contra buying in some of the stronger ones.
So you're saying contra buying could also be a strategy, but what would you suggest, in which kind of sectors then that one should be looking at? Of course, fundamentals is what they would consider, but what would be your picks then?
So we continue to like the prospects in defense business of HAL for sure, even for that matter BEL. The companies which are in the shipbuilding along with the defense orders in Mazgaon Dock. So there are some of the good companies, and we believe that I think the visibility of order book is equally very, very convincing and very, very strong. So from that point of view, I think any price correction happening in these stocks, it would probably invite further buying opportunity. But at this point of time, I think these 2-3 names, they appeal to us most, and we look for the price correction to buy into the portfolio.
I'm going to ask you about one more strategy, but let me also address something that is perhaps on most investors' mind, at least, and this especially those that take the SIP and other STP routes. Now, this after because the mutual fund industry today will be putting out the results of the stress test that they were asked to carry out. And if you go by some of the numbers that are trickling in, if you look at Nippon India Small Cap Fund, now this is among the bigger ones with higher AUM, they say that they will require about 27 days to sell off half of that portfolio. Remember, this is going to come. They have to give out numbers for how much time it will take them to, liquidate those at either 25% or 50% of their portfolios. And these are the numbers coming in. So for Nippon, they are saying about 27 days, whereas Edelweiss is saying that they could do it as less as 3 days when it comes to about 50% liquidation. DSP Small Cap Fund is saying it will need about 32 days to liquidate 50% of its portfolio, whereas Quant Small Cap Fund says that it will need 22 days for that 50% liquidation. Axis Small Cap Fund also says it will need about 28 days. So pretty much everyone coming in that 1 month or more mark, other than Edelweiss, who said just about 3 days. But Deven, I want to understand from you, as a retail investor, somebody who takes that SIP route, is this some bit of worry that is coming in? Because of course a lot of the money pumping in, or the inflows coming in, was through these mutual funds, and more importantly from the mid and small cap. So is there a rethink needed when it comes to even this strategy that you use when you're choosing your funds?
So more than a retail investor, I think it is a worry for me as a fund manager if I am managing the retail fund. Because on one side, I'm getting continuously the new SIP money into my fund. On the other side, I have no choice but to compulsorily invest that money into the portfolio stocks because of the regulations. I can't keep more liquidity into the portfolio. And all in all put together, and out of no choice, I think I have to actually buy into those stocks where majority of the mid and small cap schemes are holding the stocks. I think today 65 to 70% are the common stocks across all the mid and small schemes across all AMCs. So I have no choice but to, I think, keep participating in this rally because the fund is flowing in my scheme. Now, having told about this particular subject, I think investor on the other side, he feels that I think, yes, his fund manager is possibly deploying the fund, and that is where he should be continuing to put in his SIP. The challenge is on the size. In my understanding, I think till the time we address the issue about, I think, the smaller market cap companies, by way of, I think, creating a systematic approach of building the market making into those companies, we are likely to see this situation continuing forever. In fact, I think it will haunt us forever if at all, I think, we don't address this situation. So in my viewpoint, I think it's a very structural issue. Neither the retail investor nor the fund manager, but entire stakeholders, I think, in this entire game will have to be a little bit more cautious and worry about. Given the kind of smaller size companies which are getting froth, I think the froth is coming because of the liquidity. I think that part one will have to work out very seriously. And I believe the regulator is on the job. So I guess I think we should be expecting positive outcome out of it.
Deven, quickly your word on Paytm as well, because that is something that people are going to want some bit of clarity on. There is both positive and negative news coming in for that counter for the past couple of weeks, one would say. Today also getting that third-party approval for its UPI services, which will continue, and the tie-up with the banks per se to go on to facilitate that kind of action. So how should one be looking at Paytm, and also then counter the banks that are actually going to aid this process?
So the Paytm bank was the conduit for collecting the MDR money from RBI under the scheme. Now with the Paytm bank going away, that money will go in the fold of, I think, those partner banks with whom they are going to work, if at all, I think it will be. That's a very small money comparatively. If you look at the size of the digital transaction, UPI transaction, vis-a-vis that money which used to come, I think there's very small money. Particularly for Paytm Bank, it was big money, but overall, I think at a country level, if you see it, it is a small money, 1,600 crores across all the players. Not enough. So in fact, I think the entire UPI gateway business of these companies, they are not remunerative. It is not generating any kind of transaction income for them. So one will ask this question that how would Paytm make money? And that clarity, if till the time it comes, I guess I think we are going to be seeing the situation of some hopes and some despairs.
Right.
In my viewpoint, I think it is safer to not touch this kind of situation in the companies. I guess I think till the time you get the clarity emerge on the revenue model of the company, one should stay put on putting any further money into this kind of business.
Right. So you can see that counter there also locked up after that news in that 5% upper circuit that it has been given. But quickly, let me also go across to Brijesh and ask him what are his recommendations for our viewers today. How should one be trading, and what are the stock picks that he is suggesting?
Yeah, so I think I'm going to skip the frontline stocks. So I think there is a negative bias. Nifty and Bank Nifty is going to slip, is what it looks to me. So maybe some positional trade. Century Ply is one from the Midcap. I think it's given a good buy in yesterday. There was a volume breakout. So I think that momentum might get continued in Century Ply. So one can go long at current price with a stop loss of 655 for the target of 750. This is little bit of a directional view. I think that is one. And next one is the Hindustan Copper. At 260 level, it looks quite promising. The risk reward ratio is favorable. With a stop of 245, I think we can bet for 320 on the higher side.
Right.
So that are the two bets right now.
Right. Hindustan Copper also has just managed to get out of that NSE F&O ban list at least. So maybe there's more action now on that, even in that F&O segment. Otherwise, it was only the cash segment. Quickly, I also want to get the last word from Deven on what would be his sectoral picks, if not stock specific, in this kind of market where we are seeing, major swings, one would say. What exactly is somebody who, just wants to perhaps enter the market but is seeing this bit of chaos? Would this be a right time? You would say that buy on dip strategy continuing, if at all, that's the sentiment on the street?
So yes, I think we buy on dips, particularly in the large cap stocks. We believe that I think there the margin of safety is higher. The valuations are not comparatively expensive. And at the same time, the growth in large cap stocks in profit earnings, I think, is basically assured for next 2 to 3 years in the visibility format that we see it. So frankly speaking, I think we would be very comfortable buying into some of the large cap companies when the market gives opportunities at corrected valuations. We have specific stock recommendations. No, we don't give it on the channel. But yes, I think we feel that I think it is important to look at some of the companies, I think, which are in large cap space, the likes of Reliance, the likes of Deven. They remain, I think, they are even State Bank. They remain relatively, I think, a stronger play going forward from the investment perspective in our viewpoint. Again, I think disclaimer should be added to this subject.
Right. Deven, quickly, we also have the SEBI board meet that will, happen later this evening. And there's lots of anticipation, at least from investors, whether there will be more clarity on that whole FPI disclosure, because we saw some bit of correction because of that initially. Then there is a lot of talk about, what kind of action they're going to be taking when it comes to the SME IPO front. Then there is the T+0 and when that will actually come into play. What do you think, what are you really expecting Madhvi Puri Butch to be telling us by the end of the evening? What is the anticipation, at least from your end?
In my viewpoint, I think the regulator is definitely playing a very constructive role in building our markets. Their actions at times, I think, are not favorable to the market participants, but that's the other side of the story. I believe that overall the regulation framework in the country is quite healthy. I would only wish that I think the regulatory framework becomes proactive than remaining reactive. That would be the only wish. Otherwise, I think they know their subject well. So honestly speaking, I think we should be listening to them first, and then we should give our views thereafter.
Right. Well, let me thank both my guests then, Brijesh from IDBI Capital as well as DRChoksey for joining us this morning and giving us that broad-based perspective of how one should really be trading in this volatile market, one should that we could call it for now. But thanks so much for giving us your time and speaking with us. And to all of our viewers who tune in every day, do keep sending us your queries on our live feed, because that's where we'll want to take them up. We'll have them addressed by our guests that join us on the show. So do keep writing to us on our live stream. But for now, it seems like that's all the time we have on this edition of Opening Bell. We'll be back on Monday morning to get you all the news and cues that you could be looking out for. For me and the entire team that puts this together, thanks so much for tuning in.